This is Dennis, and in this session I want to introduce the 9 numbers you need to know to manage your business effectively. You'll learn where the numbers come from and how to use them to diagnose the health of your construction business. Yeah, it is accounting, but it's applied accounting in which you realize that the numbers are really telling you something important about your management style and about the success of your business. So suck it up. This is stuff you need to know to run your construction business effectively. This is information meant for action. On the agenda for this session, we will learn the one most essential measurement, the vital process of measuring performance, the origins of the 9 numbers, the usefulness of knowing your 9 numbers for proper management of your construction business, and 3 critical questions the 9 numbers can help you answer. While we will be discussing 9 different numbers in this presentation, recognize that there is only one measurement that ultimately relies on the performance of your business. That measurement is the amount of personal wealth that your business is creating for you. However, wealth is the destination, not the journey. The journey is a bit more demanding. To reach the destination, you will need a few tools. You'll need a roadmap, an odometer, a vehicle, and some degree of driving skills. For our purposes, and I promise to drop this tortured metaphor once this point is made, our roadmap will be 3 accounting statements: the cash flow statement, the income statement, and the net worth statement. Our odometer will be periodic performance comparisons of numbers in those accounting statements. Our vehicle will be the 9 numbers which I'll be introducing in this session. And our driving skills will be our management processes we put in place to respond to negative changes in the measurements. But first, one more thing. The 9 numbers are all about measuring. It is a management truism that you cannot manage what you cannot measure. But there's an important corollary to that statement, and it's absolutely critical to your success in creating wealth or running any part of your business. You are not managing if you are not measuring. No matter if we're talking about financial performance, employee behaviors, lead generation, or inventory management, the only way to successfully manage any part of your business is to set a standard and then measure performance against that standard. If you're not doing that, you're not managing. You are hoping. You are just hoping things turn out for you, and that is a dangerous type of business management. Okay, so let's look at how we're going to manage our journey toward wealth. We're going to be looking at 3 basic components of wealth building. Cash flow is the stream of money you are able to generate from the work your business does. From that stream of money, you will extract income, which is the amount of money you can convert to your use from the stream of money that you've generated. Anything left over adds to your net worth, which is comprised of the assets, the things you own free and clear. The accumulation of these assets, which includes vehicles and equipment and retirement accounts and land and cash, represents your wealth. So if we're interested in the wealth production of the business, we will have to measure and manage the cash flow of the business, the income of the business, and the net worth of the business. Let's take a look at how we can do that. First, let's take a look at what makes up the cash flow of the business. We begin with starting cash. How much money did you have in your accounts at the beginning of the period? To that, we add the amount of money that came in during the period, from sales, from money we borrowed, from money from the sale of something we owned, and we deduct the amount of money that went out during the period for payments for materials, payment to subcontractors, for business expenses like insurance, loan interest, office supplies, for payments on loans, and that will give us our ending cash. Essentially, the cash flow statement can be viewed as the checkbook for the business. It tracks the flow of cash attached to the activities of the business. The income statement is a little more refined. The purpose of the income statement is to demonstrate if the business is able to sell its goods and services for more than it costs to produce those goods and services. The first item we look at is the amount of sales. This includes only the amount that was invoiced to customers for services or goods provided. It does not include the sale of a piece of construction equipment that was no longer needed or the money we borrowed to buy the truck. It was just money that was produced from the production of the business. The second item calculated is the costs. These are associated with the production of those goods and services that were sold during the period. Costs include direct costs such as subcontractor labor, materials allocated directly to projects such as excavation, the foundation, the framing package, roofing materials, the doors and windows, and so on. Costs also include indirect costs, which are more difficult to allocate to a specific job. These costs include management salaries, office expenses such as rent, utilities, and telephone, vehicle expenses, marketing expenses, and many more items. I'm sure you can create a long list there of costs that are not related directly to a project. When all the costs are deducted from the sales, what remains is the profit. If that number is positive, your company made money. If it's negative, your company lost money. Profits are not cash in the bank. You cannot spend profits. Profit is a simple accounting function. Sales minus costs equals profits or loss. Now the final set of three numbers comes from the net worth statement. This document tells you if your business is working to increase your wealth. The first number is assets. These are the things you own and include cash and money in the banks, money that is owed to your business, also called accounts receivable, land and materials you're holding pending work, that would be your inventory, projects that you are currently working on but that are not completed, which would be work in process or WIP, and equipment, pickups, forklifts, computers, phone systems, and so on. The second number is debts, also called liabilities. And these include money owed to subcontractors, money owed to suppliers, short-term loans like lot loans or material loans or something like that. Basically, they're going to be paid within the year. And long-term financing, which is made up mostly of business loans. The third number is net worth, which is assets minus debts. However, the correct formula is, by accounting convention, assets is equal to debts plus net worth. This results in the net worth statement, which is also called the balance sheet. You get it? Assets equals debts plus net worth, which is balanced. So now we have all 9 of the numbers that are necessary to get a grip on the performance of the business. 3 from the cash flow statement, 3 from the income statement, and 3 from the net worth statement. So how can you use these 9 numbers to analyze your business? What was your starting cash balance? How much came in from sales or other sources? And how much went out for materials, labor, debt service, and overhead? How much cash is in your accounts at the end of the period? What was the total of billed sales for the period? What were the total direct and indirect costs related to those sales for the period? Did you have a profit? Sales were greater than expenses, or a loss? Expenses were greater than sales for the period. Do you know the current value of your assets? And do you know how much is owed against those assets? If you know those 2 numbers, then you know what the net worth of your company is. But more importantly, you know if your company is making you wealthy. If you know the answers to most of those questions, you have a basic understanding of the financial systems of your business. You just need a structure to put the numbers in so they make sense. That structure, that system, is called accounting. Just like we structure our sentences and paragraphs to speak in a language, we structure the 9 numbers in a specific way to speak the language of accounting. If you know the answer to those 9 questions, you've been speaking the language of accounting, whether you knew it or not. In summary, the 9 numbers encapsulate all the important financial information you need to know about your business. They are the basic components of the cash flow statement, which is a lot like a checkbook, the income statement, which is that shoebox that you have full of receipts and bills and other financial information, and your net worth statement, the financial snapshot of your business at a specific point in time. All of the 9 numbers can be managed, and by managing these numbers, you can plan to make your business more successful. The cash flow statement answers the question, is the business going to survive? Without cash, the lifeblood of a business, the end will come soon. With the information available in cash flow statement, you'll be alerted if there's a problem and you can act to fix it immediately. Let's look quickly at how a manager might look at these 3 sets of numbers. Starting cash is history. It is what it is. Cash in can be managed. Sell more product, write your contracts with shorter draw periods to speed up cash flow, stay on top of your accounts receivables, bill and collect for change orders immediately. Cash out can also be managed. Drive better deals with your subs and suppliers, take advantage of supplier discounts. If necessary, you can even stretch out your payments so that the cash out is moved to a later period. Ending cash is the future. By managing the cash in and cash out, you can make it better for you. The income statement answers the question, is the business healthy? Like any organism, a business may experience setbacks, but if the business is well run and thriving, the overall movement will be toward growth and sustained profitability. To increase sales, take a look at your marketing, your lead generation, and your conversion rates. Should or could they be better? Look at your proposal turnaround time. Are you sending the right message that you care about their project to your prospects? Have you positioned yourself as the owner of a niche in your market? Or are you a Me Too builder? Are you billing for change orders immediately and collecting on or before the next draw? To decrease costs, you can manage your subcontractors better. Are you using scopes of work and inspecting the jobs for quality while the subs are on the site so they get the work done for which they are responsible? You can manage your suppliers better too. Take advantage of supplier discounts. Place complete orders so your site managers aren't constantly running to the supply house. Combine material orders to take advantage of quantity discounts if you have several projects going at once. Shorten production turnaround by reworking your schedules to squeeze out lag times. And then finally, the net worth statement answers the question, is the business making me wealthy? If the net worth section of the statement is increasing period by period, the business is performing as it should. If not, there are steps you must take. With regard to your assets, are all of your assets, forklifts, expensive specialized tools, and even airplanes, earning their keep, or are some of them in the category of big boys' toys? Do you track the size of your accounts receivable as a percentage of sales to make sure they don't get out of hand? Are you carrying dead or outdated inventory that should be sold or otherwise disposed of? Have you discussed your equipment depreciation schedules with your advisor to make sure that you are making the best choices? Is your risk management program, think insurance policies, adequate and well planned? With regard to your debts, are you constantly turning operating loans into long-term financing? Do you know what your debt-to-equity ratio is, and is it decreasing or increasing? Do you have a long-range plan for retiring debt? The purpose of this session was to introduce the 9 numbers and illustrate their importance to managing your company. At this point, the 9 numbers are simply informative and diagnostic. We've barely scratched the surface regarding proactive management of your construction company using the 9 numbers. We'll discuss specific management techniques you can use in upcoming sessions.